Welcome to this explainer. Today, we're diving deep into the inner workings of an absolute corporate juggernaut. We are going to break down Lenskart's FY 2024-25 Directors Report to uncover the true anatomy of a sprawling retail and tech empire. Because honestly, this isn't just a story about selling glasses. It's a total masterclass in aggressive scaling, strategic acquisitions, and global market dominance.
Before we really get into the weeds here, just take a look at this number. Nearly 3 billion rupees. That is Lenskart's staggering consolidated profit for the 2024 to 2025 financial year. It's an incredible financial turnaround that fundamentally sets the stakes for everything we're going to talk about today. How exactly did a company achieve this massive level of profitability in just a single year?
To figure out how they did it, we're going to use these 4 chapters to map their exact moves. We'll start with the big financial swing, move into driving retail and franchises, explore the global subsidiary empire, and finally unpack their strategy and corporate moves.
All right, let's jump right into Chapter 1, the big financial swing.
The sheer scale of this momentum shift is honestly unbelievable. Just look at this. Back in 2024, they were sitting on a consolidated loss of over 100 million rupees. Fast forward just 12 months, they catapulted to that massive nearly 3 billion rupee profit. I mean, in the corporate world, swinging from a loss to a profit of this magnitude, that requires a fundamental shift in how you're doing business. So how exactly did they tip the scales? Well, when we break down the operations, we see their total revenue hitting a jaw-dropping 66.5 billion rupees, which finally outpaced their massive 66.1 billion rupee expenditure. It's basically the ultimate startup dream coming true, right? Growing so big and so fast that your revenue engine finally just laps those fixed expansion costs. They literally grew their way into profitability.
Which brings us perfectly to Chapter 2, driving retail and franchises.
Now, if you're wondering what operational levers they pulled to get that top-line spike, the directors actually stated super plainly in the report. Quote, "The entire business growth comes out of companies' consistent efforts of increasing the franchisee footprint during the financial year." So, the secret sauce here wasn't some crazy market anomaly. It was a relentless boots-on-the-ground expansion of their franchisee network. It goes to show that sometimes the best growth hack isn't digital at all. It's a massive physical ground game.
And they paired that physical footprint with a brilliant dual-pronged strategy. First, they expanded rapidly through a wider franchisee network. We're talking putting stores on virtually every corner. But second, they backed that up with wildly aggressive media campaigns to generate massive brand awareness. You open the doors and you blast the ads so those stores are packed on day one. It is a textbook retail domination play.
But organic growth just wasn't enough for them. A huge piece of this retail domination puzzle was a major consolidation play, acquiring 100% of Lenskart Online Services Private Limited. To put into perspective why this is such a big deal, Lenskart alone brought in over 13 billion rupees in revenue this year, netting over 86 million in profit. So by completely absorbing them, Lenskart just dramatically turbocharged its domestic revenue engine.
Okay, let's zoom out a bit for Chapter 3, the global subsidiary empire.
Because, as you probably know, Lenskart is definitely not just an Indian retail story anymore. It has evolved into a sprawling global empire. To really grasp how they manage this, we need to talk about a concept called a step-down subsidiary. Basically, this is a company owned by another subsidiary rather than directly by the parent company. So Lenskart uses a master entity in Singapore, which then owns these step-down subsidiaries that actually run the show in places like Dubai, Vietnam, Malaysia, and the US. Think of it like setting up highly focused regional command centers instead of trying to micromanage the entire globe from a single desk in India. And their global attack plan is genuinely fascinating. They're basically fighting on 2 distinct fronts. On one side, they're taking the core Lenskart brand directly into massive markets like the UAE, the USA, Saudi Arabia, and Indonesia. But on the flip side, they are completely taking over other Asian markets through their massive Owndays acquisitions, which they manage out of Japan. Through Owndays, they suddenly have this dominant stronghold in Taiwan, Australia, Hong Kong, and Thailand. They're conquering the world, but they're smart enough to use different brands tailored to specific regional tastes. But hey, global scale costs serious cash. While those mature, domestic-focused subsidiaries like Lenskart are printing profit, these aggressive new global expansions, that's a different story. Take a look at Lenskart Arabia. It operated at nearly a 500 million rupee loss this year.
But here's the thing. That isn't a failure at all. That is a highly strategic loss. They're actively choosing to burn capital in new territories to aggressively grab market share. And they're subsidizing that massive global land grab with the profits from their domestic operations. Which naturally leads us into our final section, Chapter 4, Strategy and Corporate Moves. Let's peek under the hood at the corporate machinery driving all of this. I found this fact completely mind-blowing. You'd assume an eyewear company blows most of its cash on flashy marketing and billboard models, right? Well, think again. Their marketing spend was around 13.5 million INR, but their software expenditure? Try a staggering 250 million INR. That is over 25 crore rupees spent entirely on software. This right here proves that Lenskart is operating just as much like a heavy-hitting, data-driven tech company as it is a traditional retailer.
And they're keeping that technological edge sharp by pouring capital into the broader tech ecosystem. The director's report outlines some super strategic corporate investments in tech-driven startups. They secured shares in Alloy Technologies, invested heavily in We Hear Innovations, and even set up a 50% joint venture with VisionSure Services. They are not just selling glasses, folks. They are literally building a technological moat around their core business. It's a masterclass in how to future-proof a retail brand.
So how does the management team actually feel about all this momentum? Well, as a massive show of corporate confidence in their turnaround and future trajectory, they decided to heavily reward their shareholders. In October 2024, they issued an absolutely incredible 69+ crore, or nearly $700 million bonus common equity shares in a 1-to-9 ratio. That is a seriously bold move, and it sends a clear signal about their internal belief in the value they've created and the future cash flow they're anticipating.
When you step back and look at this entire document, from that unbelievable nearly 3 billion rupee profit swing to these strategic own-days acquisitions to that colossal tech spending, you really start to feel the sheer, unstoppable momentum behind this company. They've engineered an incredibly complex, highly effective global machine. So the only real question left for us to ponder is this. Armed with this kind of profitability and a sprawling Asian empire already locked down, what global market is this tech-driven retail giant going to disrupt next?